Good afternoon, Scott Redler, T3 Live. Welcome to today's recap. So we came in today trying to figure out, can we get some type of oversold bounce? Market's been dancing around the 200-day moving average. We've been talking about what typically happens once you break below the 200-day. What happens is you play that game, the whole, are we above, are we below? So the way institutions get rid of stock, if we are to go lower, is they use these moving averages as vehicles to push things around. So if we would have went below the 200-day and just collapsed, basically most people out there would have thought game over, and maybe we don't bounce, and they couldn't induce any more buying. So when they play around it in the last 2 days, they rejected it. Today, it finally took it back. Now the question is it a trap? Does it lead to more upside? To me, I think it opens the door to a little bit more upside. You just have to figure out whether or not you want to play it. I do think that this is a rally to be sold. The question is, from what level? And today there were guys that could make money cash flow-wise, and I think that's where I made most of my money today from the long side, but that's as a tactical trader. And as a trader, you need to have tactical plays ready for when things move fast. And today when we came in, morning call, I talked about the $4.2 billion write-off in JP Morgan. It was down like 30 cents. And I was like, you know what? If the market wants to have a bounce type day, all they probably have to do is trade JP Morgan positive, let it go green, let the banks get a bounce, and pow, we take back the 200-day. And that's what happened, because they sold the rumor, bought the news. So now people say, okay, maybe all the bad news is done with JP Morgan, so we get some type of bounce. So what you do is just realize if you're playing it for a bounce, and where it can go, where you take off some of the trade, where you take off all the trade, or where potentially you reshort it, but you obviously don't want to start too quick. If you take a quick look at the chart of the spiders, you will see, after the head and shoulders top triggered, we met the measured move, we had this bear type flag, broke below it with the jobs number, and now you had a bit of a reversal bar yesterday, and today we had a little bit of follow through. And this is what we call follow through these days. A little bit right there. It traded above yesterday's high of 28.74, closed above the 200-day of 128.75, and closed at 129.07. So the question is, where does it go from here? So what you want to do is, if you are playing this for an oversold type bounce, A, it's a bit risky. B, just know where it could go. And from now, you have the start of the gap here at 129.86. 129.86 is basically where we opened, or the high of the day of the bad jobs report. So this is an important level to have, 129.86. Also know that the low of the pivot from May 18th was 129.55, which we got pretty close to. So in my humble opinion, I think the market could push to this area, especially considering the ECB's meeting tomorrow. Maybe they cut a half a point. Maybe that adds fuel to the fire. So right there, we could bounce to this area. And I also think there's a chance that it could retest this zone. And if you look here on this zone, this is 131.42. So if you're trading it for a bounce, perhaps I would have sold some on the close and taken a little bit long for some follow through. It's worth a trade considering where we came from, especially if you sold here, or you sold here, or even if you sold here, you have the luxury of buying it back. And then maybe play it, see how we go into this gap, see how it handles it, and then this would be an area that I think is a meaty short, back at 131.40, and I guess even to here. So if the bears have control, which I do think they have control, they will not let 131.40 to 132 be reclaimed. So easy part of the bounce, harder part of the bounce. And with that said, that's what the type of mode we're in right now. We shall see. For me, I'm not really that interested in taking that many overnights lately. That there's been no need to. You have tactics. Today we talked about JP Morgan. JP Morgan had that trade, or had that announcement of the loss. They said 4.2. I'm actually hearing it's more like 5.5 or more. So we'll see, when that dirty laundry gets exposed. But for now, 4.2 billion's been absorbed. It's out there. You look at the stock. You'll see here. You had a reversal type day. It opened lower. It really did an 80-20 because it was as low as this. It was this low pre-market. It was as low as 30, I think 60. So right away I was trying to actually buy as much as I can at 31, which was right around here, because this was this close, and my system was screwed up. If you're on the virtual trading floor, guys got it and I couldn't. So I'm happy for you guys and for my crew. For me, by the time I was able to get my system together, it was already 31.40. So it shows you how quick you had to be. Off the open, you go to JP Morgan. If you were prepared, which a lot of my guys were prepared, look at this move off the open. Okay, you had to be prepared and wait for the market to confirm it. Right here, this was a huge, huge move. Okay, it doesn't look like much, but percentage it was. And then even if you missed that move, for the first time, it went up, flagged, held higher. So even if you said it's a little too early for me to commit here, once it held this 31.50, you had another nice percentage move all the way up to 32.10. So that was a nice cash flow trade without saying the trouble's over with the banks. All it was a tactical buy. Okay, now you have a little bit of a resistance zone. You have the low from, what was this, May 21st, which was 32.26. You have yesterday's high of around 32.17, today's high of 32.13. So if we were to open lower, maybe as a cash flow trade, again, if it clears this area, the next spot is 32.66, and maybe to fill this gap, and then that's where I would think some resistance gets put into place. So this is your next little action area. If we open above it, that trade gets taken away. But if we open below it, maybe some buying comes back and it trades above there, squeezes some shorts that stuck around, and you get that additional move. And then I guess there's another gap all the way up here, but if JP Morgan were to get all the way back to this spot, chances are we're probably back at 1340 in the S&P versus pausing at 1307 to 1312. So that's another way to gauge things. As traders, you try and gauge things. In my head, I was saying to myself, if we go to 129.50 to 130.50 first, I tweeted about it a few times, chances are there are a few things that could happen that you could trade with it. And one of them was JP Morgan probably going to 32.60. Another was LVS and Wynn. Finally, they had a reversal pattern. I'm like, okay, if we continue to the bounce, why can't LVS get to 46? LVS is on its way. Finally, a potent type day where it actually, here's your same type of pattern as the spiders, where it made a new low, came back above, so it was the beginning of a reversal pattern, and then it triggered above this high here, which was 43.53. I did not really make money here. I was in Wynn, which was my decent trade for the morning, but LVS closed pretty strong. To me, I think that this spot's doable for continuation, and then maybe even into here, considering where it came from. So this would be the easy type trade where you had your reversal, here's your continuation, and then here would be a small amount of follow through. So that would be a spot that I would be isolating, and just don't try and short it so damn quick. It's a first bounce day, closed near the highs. Stock came in from 62 or so. It's down here. So just be a little bit careful. But I think it can continue there for Wynn. I went with that one. I don't know why. Typically, I'm a little bit more comfortable with LVS. Maybe I would have more size there. But again, I was a little screwed up because of my keys. But this one worked. Similar, this one had a green bar, traded below the low here of 96.52, came up. I was buying it when it went above this high here of around 98.50. Guys on my virtual trade floor, I think, took the trade with me. Closed near 101. This also has some room to like 103, 105. So it can continue, considering it just came from 135 before you had this outside day reversal strategy. So again, there's a big difference, for leaders and laggards. If you sold this area on this reversal day, or sold when it broke this little area, or even sold when it broke this pivot, you have the luxury of trading some type of bounce back to resistance. But just realize that this is a battered and bruised sector, and it's providing cash flow doesn't necessarily mean it's a bottom or something you could stay with because it's below the moving averages and it's not acting well. The same way in retail, you have stocks that have been investment quality that didn't give investors so much pain, and then you have those that are in the doghouse and that should have been avoided. Just say look at Under Armour. Under Armour, really nice chart, guys. Okay, this stock holding higher. It's above the 100-day, above the 200-day. It's even above, I think, the 20-day. It's near new highs. If you're an investor in Under Armour, you probably haven't had to flinch. You're feeling pretty, all these headlines, and you're like, you know what, I'm doing just fine. So above this 100 area, perhaps it's a candidate if the market says it wants to continue to break out. Under Armour looks good as a macro trade, and it's showing relative strength. So it reacted well today. Okay, so did something like a Target. Target also, above the moving averages, not great, but it's still hanging in there. If you're an investor in Target and you bought correctly and you bought when it cleared this area, or when it retouched, or it came down to this, what was this? I think the 100-day moving average, and most of the strongest stocks in the market held the 100-day. Because if the markets went to the 200-day and the stock held the 100-day, what does that tell you? Relative strength, something you could stay with quicker. But for it to break above this resistance, you're going to need a better market. But Target, decent. Lulu, decent. Little faulty, but still trying to hold the 100-day. But then you look at something that's in the same group, but battered and bruised and could bounce, but investors have been annihilated if they didn't use stops. Look at something like, just say, JCPenney's. Okay, JCPenney's crushed. Much different than your Target, much different than your Walmart, much different than, Costco. Look at Costco. Costco actually looks good. Costco looks as if it's ready to give you a cash flow trade above this, 87 area. So that looks good. But then you look at something like JCPenney's, it's annihilated. Okay, so the question is, can this, could you play it for a bounce versus slow? Look at these moving averages. It could be worth a bounce, but you have to know what you're looking to get out of this thing. Or something like Tiffany, horrendous. Okay, stock's been annihilated. It broke all its moving averages. Look at this little bit of a bounce play. Okay, so if you're playing Tiffany for a bounce, you better know that's all it is. Okay, little bounce off the low. Maybe it tries to retest this gap, and if it gets even a little bit more power, perhaps it fills a portion of it. But this is just an oversold bounce play that you should not have been long, because it went below every moving average, didn't show you any relative strength. Not like in Under Armour that's still acting well. Not like a Target that's still acting well. Not like a Costco that is above all the moving averages. So it just shows you, some stocks to stick with. And high-level stops are the same way as low-level stops. So if you actually take a quick look at Walmart, I would just be a little careful here. If you're playing for continuation, just know that if it breaks below this 65.30, you might get a pull-in to retest this breakout or maybe even this moving average. So just know that you can trade these things. You had your nice gap up. Never even attempted to fill it. It's above the moving averages. If you're an investor in Walmart, you're very happy. But sometimes you see things change. That's why you have high-level stops. That's why also with the home builders that acted really well, all of a sudden they changed characters. Most guys that I spoke to got out right here, and even though you had a nice bounce back play, you rejected it, and now look where it is. So you just got to know what you want out of these things. And as much as you want to have an upper level stop, you have to, or a lower level stop, have an upper level stop to protect some gains. Sometimes you protect the gains and it turns into a disaster. Sometimes you protect the gains and a month later it's higher. So you have to know whether or not you can get back to it. Another stock that people are talking about that crushed, A&F. Look at this. You finally have a green day. Green day. If you got out of it in here, or you got out of it when it went below this and when the moving average started curling over, or you got out of it even late when it broke this support here, you look at this little green bar, maybe, if you're a quick trader, you can get a bounce back to this 33.85 level. But just know the difference in the type of trade. What I'm trying to show you is the different type of trade. If you're a macro investor and you're holding and you're a stock picker, there are stocks to hold that have the ability to make new highs in any market when markets bounce, and then there are stocks that violated all the rules that you got stopped out of that. If you sold correctly, you could buy back for a bounce, like some of the banks that worked out today that might work out a little bit more. Some of the casinos that if you sold correctly when they broke moving averages or broke trends, boom. So just know what's tactical and what's risky. And then you talk about gold. Gold, I'm still long. It's hanging around. If you've been long since, this gap up, because that's the day that I went long, you've really had no reason to get out of it yet. You had 2 inside days holding the majority not only of this wide range bar, it hasn't even come to test the gap. So really tight guys will probably be using this as a stop, which is as low as just say 156.16. guys with a bit more risk tolerance who are more committed, might be a gold bug or a bear or whatever it is, this should hold this gap of 154.87. I'm in tier 1 and change, and I'm hoping we can get a small trade above there first. Let's make it a little closer. Here would be, above, just say you want to do a tier system. Just say gold opened up flat tomorrow. You're in tier 1. It starts clearing 157.44. Maybe you get to tier 2, and then all of a sudden it comes up to 158.31. It pauses. You sell some. It holds, goes sideways. You get back in here. Then you sell some maybe if it tests this intermediate gap around 159 or so. So, and then to really change character and break this intermediate downtrend that gold's been in, the GLD's been in, it really has to get above this 159-ish and close above it. I would even say for everyone to really start trusting it and for it to get some power, it's going to have to trade and close above 161.70. So right now you're somewhat anticipating a new trend or a trade. You're anticipating the lack of faith in currency. You're anticipating a new identity in gold, which it hasn't had this entire year. So with that, keep it tight. Know this level, that level, and know what you're looking to get out of it. For right now, it's somewhat developing, but it's been developing somewhat this entire year and it's failed. So just don't have an opinion here. So far there's commitment. We'll see if it continues. So tomorrow, again, the ECB's meeting. Some are hoping for a quarter cut. Some are saying a half. Guys I talked to would love to see a half. It'll show that they're going to be aggressive, and that could help our rally continue. If they do a quarter, maybe we open up and people are like, they're just trying to appease everyone. There's still no commitment to some type of coordinated effort. And then really, the big summit is at the end of the month. So we have a long way between now and then. And there's even some talk that guys think they're going to do nothing because they want to impulse and strong arm the politicians to be at wit's end in order to do something, because it seems like Europe just comes up with some kind of choice or decision at the final hour. You also have the Greece vote that I think is June 17th, and then you have our Fed. So there's a lot between now and then. So we could have some type of bounce into those resistance levels I showed you, but we don't have to. So just know what you're playing for, know what type of stock you're in, and be tactical and know your time frame. Scott Redler, T3 Live, the recap. See you at the morning call. Have a good night.